Okay. Good afternoon, everyone. I'll just give it another 30 seconds or so because I see the participant count is slowly rising. Okay, I think we've got a critical mass to kick it off. So good afternoon, everyone. Welcome to our second webinar of the season as part of our monthly educational events lineup. For those of you who don't know me, my name is Daniel Kirshner, and I'm the program chair for the CFA Society Ottawa. Today's presentation will cover private market strategies within a portfolio context. We've witnessed strong volatility in public markets recently, with expectations of continued downside risk amidst weak economic growth next year. We have the pleasure of hosting Fiera Capital to discuss an actionable framework whereby professional investors can better diversify their investment programs to take advantage of the risk mitigation and return potential provided by private market solutions. The event format will be a presentation followed by an audience Q&A. You'll be able to ask questions via the Q&A function at the end, and I'll ask them on your behalf. Please note that the event will be recorded. For now, I'd like to welcome Sarah Butcher, Senior Capability Specialist, Private Credit at Fiera Capital. Sarah is responsible for generating new business opportunities amongst Canadian institutional investors for private credit strategies and leading Fiera's growth in global private credit. Sarah's career in the institutional asset management industry spanned nearly 2 decades before joining Fiera Capital. Before joining the firm, she was a dealing representative assisting global investment management firms cultivate new institutional investor relationships. Prior experiences include roles within the institutional client group at Neuberger, Berman, and BlackRock. Without further ado, Sarah, the floor is yours.
Great, thank you very much. And thank you everyone for joining us today. Let's bring up the presentation there. So today we are going to talk about a practical implementation guide for including private assets in your portfolio context. So I thought we'd walk us through step by step on kind of how to do this and why we should care at this point in time. So we'll really set the stage by talking about who the participants are, how this asset category has evolved over time, move into why now? Why are we focused on this at this point in time? Where has this urgency arrived from? And then finally, we'll spend the bulk of our presentation talking about how to think about implementation strategies, really a 3-step process to break it down into actionable items. And then finally, we'll review what we've achieved by going through this process, what we can expect to see in our portfolios, how do we think about ESG in private markets, and how do we make sure that we're partnering with the best institutional managers? So first of all, migration into private market. You may be familiar with the Yale endowment model, and this is really where institutional investors began investing in private markets, traditionally more of a banked market. Really going back to the late 80s, we saw Yale really pave the path for endowments to begin to broaden their investment universe, really looking to private investments to bolster the return opportunities that they saw. Moving forward into the early 2000s, Canadian pension plans really began to pave the way globally in terms of allocations into private markets. So you may have referred to this group as, Maple 8. These are the largest institutional pension plans in Canada, really moving into private markets. And really from their perspective, they had very large asset pools that they were looking for diversification benefits. So ways to, yes, increase returns, but really also to diversify how they were investing in the markets. So this really was the beginning of that risk side of the equation. And then finally, towards post-GFC, really when we saw interest rates decline steadily over a long period of time, broader institutional owners were looking for increases in returns. So their traditional fixed income portfolios in general, but broadly their broader portfolios, really looking for bolstering returns in their portfolio, and then also increasing the risk diversification as well. So we went from a participation rate at the beginning of the 2000s of about 7%, and now allocations in Canadian DB plans hover around 25%. So we've certainly come a long way in terms of the adoption of private markets. And now we've seen, many new participants also engaging in the private market space. So globally, what does this look like? Private equity has certainly kind of forged the path and was the earliest private market that we saw being adopted globally. But Canadian investors have really focused their attention on these three categories: real estate, infrastructure, and private debt. And as we'll see as we continue our conversation, a lot of this really focuses on the risk categorization, the improvement in the overall risk profile. I think Canadians are generally maybe a little bit more risk adverse. And so really those diversification, stability arguments around these asset classes have particularly resonated with Canadian investors. So we did a bit of an experiment really looking at how portfolios have behaved in actual market environments. So we took a typical public portfolio that we see on defined benefit pension plans. So 40% universe bonds, 40% global equity, 20% Canadian equity. So this is your typical 60-40 mix. And we also looked at kind of a diversified portfolio across 5 main categories of alternative assets. So equally weighted portfolio of private markets. So not what we would suggest in terms of implementation, but really wanted to see public versus private. How do these types of portfolios perform in different market environments? So the first market regime that we looked at was bull versus bear. Markets are going up versus markets are going down. So on the left-hand side here, we have public market performance. And on the right-hand side, we have our private portfolio. So how did they do? And so you can see that in a bull market, not only does a private portfolio keep up, right? It's getting actually better return and participating in more quarters of upside. But really the beauty, the secret sauce is really how it participates in the downside market. So still having positive returns, even in a bear market. So when public markets are down, public markets are underperforming that zero mark, private markets continue to outperform, continue to deliver positive results, participate in less of the downside. So you can really see this in the chart at the bottom here, where downside months are limited. And that's really, one of the main benefits of having a very diversified portfolio, and in the private markets being dictated more by asset values rather than market sentiments or market flows. So similarly, we also tested our 2 portfolios in a rate market. So rates going up versus rates going down. How do these 2 portfolios participate over time? So again, the public market portfolio, you can see a lot more participation on the downside compared to private market portfolios where we have much fewer downside quarters. So again, regardless of the market environment, the private market portfolio continues to handily outperform public market portfolios in different rate environments as well. So again, really speaking to the stability over time, the lack of volatility in the underlying assets, and that diversification you get by investing in very inherently different types of asset categories underneath. And then finally, our third regime that we're testing is inflation. And this is certainly topical right now. And, an area where I spend a lot of my time talking to investors on how to create portfolios that are more resilient to this inflationary environment. And so, not surprisingly, keeping on trend, we're seeing that the participation in downside markets is much less pronounced in our private market portfolio. So that ability to really maintain value across the different types of market regimes is one of the biggest benefits in diversifying a portfolio into private markets. So we also wanted to look back, over 5 years at the beginning of this journey, why were institutional investors interested in allocating into the space? Why did we see institutional investors say that these were areas that they wanted to focus on? So it does depend a little bit on what category you're looking at, but some key themes we see emerging are diversification, right? Number 1 priority across the board, except for private equity, where we're looking for incremental return. Similarly, a source of income and inflation hedge are definitely themes that resonate really across the market. This idea that we get better risk-adjusted returns across private markets. And so we tested that, were investors happy? If you'd invested in these asset classes for these reasons 5 years ago, did your theory kind of prove out in the long term? So moving forward 5 years, diversification argument, absolutely, we've got better diversification. So any number less than 1 is less than fully correlated to public market betas. And certainly the negative correlations we see in real estate and natural resources move in opposite directions to public markets. So that really comes down to that diversification argument. And when you put non-correlated assets together in a portfolio context, your overall portfolio risk return metrics therefore improve. And we can see this absolutely when we look at the Sharpe ratio, which puts a numerical value on this. Really anything greater than 1 is fantastic. Anything greater than 0.5 is, top quartile. So we're seeing, very strong risk-adjusted returns, speaking to not only the improvement in your overall return expectation, but very importantly, that dampening of portfolio volatility that is delivered through private markets. And then again, high absolute returns. I think, some people might be surprised to see private debt, delivering such high absolute returns. But certainly in the rising rate environment we've seen recently, that's certainly given a boost to these return metrics as well. And certainly private equity, the number one reason why folks were investing in private equity, we've certainly seen that market segment delivering, high relative returns. And finally, again, inflation hedge. So this is an annualized real rate of return. So taking inflation out of the equation, still getting highly positive returns across the board. And reliable income, right? So this is really the private debt real estate market where we're really looking for a source of income that is certainly delivered as well, and infrastructure as well. So, unsurprising, I'm a little bit biased, but it proves out in the numbers, right? We are seeing that private markets are delivering that improved diversification, therefore lower risk, and, a better source of stable income and inflation protection overall. So going forward, could we expect that this will persist? Nobody can see into the future. I wish we had a crystal ball, but based on sort of all the metrics that we're seeing in the market, I think that the case definitely holds at least as well for the future going forward. Certainly as we've seen increased market volatility, that ability for private markets to, dampen or smooth that experienced volatility is going to be very important from a portfolio construction standpoint. Similarly, the access to consistent sources of return, I think, is going to become more and more important to investors as their, asset portfolios show more mark-to-market volatility. That consistency of income, that ability to withstand inflationary pressures, and really that strong overall return profile is continue to be important to investors and very achievable in private markets. That being said, obviously, private market assets are also, very much exposed to market risks as well. Certainly, economic, geopolitical tensions, credit quality are all going to play into loan selection and investment selection amongst managers. So certainly, finding the right partner, partner with the right sourcing network is going to be very important, regardless of the market that you're trying to access. And we'll talk a little bit more about some of the key features that we think are important as well when evaluating private market managers in particular. So why the increased urgency? We talked a little bit about this. The current market environment is certainly creating challenges for public market portfolios. I think a lot of institutional investors were very heavily relying on their equity returns. We saw a very long bull market in public market equities, which really bolstered portfolios. So if you have equities returning 15-20% per annum, you can have a lot of other things in the portfolio that maybe aren't doing much, like your fixed income portfolio, and still overall be doing, feeling pretty good about your position. So I think that now with equities being, certainly challenged this year, and also I would suggest, probably more correction to come in the future as we continue to reprice for the new economic environment. Certainly valuations are potentially stretched, and I would say without a doubt, volatility is going to continue to permeate that market. So certainly looking for other sources of return is become more important. Fixed income is also facing elevated risks. In a 60-40 portfolio, the expectation was that equity and fixed income betas would move in a non-correlated fashion to create that sort of ballast in the portfolio. This year, we've seen all duration assets sell off, right? So we saw high correlations between equity and fixed income that were not really modeled in our projections. And certainly, the increased credit risk that we see in fixed income as we move into a potentially recessionary environment is likely to continue to challenge this market. So looking for ways to diversify your portfolio away from traditional beta assets, I think is important really across the board. In addition, this increased volatility makes planning very difficult. So in terms of, your business plan, your spending plan, maybe servicing your obligations, it's very difficult to forecast where your portfolio is at any given time if you're subject to all this mark-to-market volatility. So having more stable sources of actual income can be very helpful from a business management perspective as well. And we're certainly seeing this, especially in charitable organizations that are seeing their disbursement requirements increase in 2023 from 3% to 4%. That's a very concrete example of a mandated income requirement that is going to put a lot of pressure on traditional portfolios to deliver consistently. And then I would also say, regardless of what type of investor you are, having a portfolio that's more resilient to volatility in all its forms and formats is very important just in terms of long-term wealth creation. We all know it's a lot more difficult to build yourself out of a negative return environment. And so creating kind of that stable baseline does create the opportunity for more, wealth creation and growth over the long term. And then finally, inflation is an area where we're all very focused as everything around us becomes more expensive. So really maintaining that purchasing power, no matter what your position as an investor, is going to be very, very important going forward as well. So this is looking at more typical portfolios. So we talked about, a 60-40 portfolio in the earlier section, and then we talked about our private market portfolio. This is a portfolio that we actually see across our clients. So this is a typical multi-asset class client portfolio managed at Fiera. So this is much more an implementable type of portfolio, and one that we recommend, on average to our client base. And so what does that do in terms of your portfolio characteristics, moving from a traditional portfolio to one that includes a diversified set of private assets? Again, numbers, right? And so, yes, it does increase your return. It does increase your income. It substantially decreases your volatility, right? This is the portfolio effect that is so important. And the result is an increase in your Sharpe or your efficiency of your portfolio. So it has been proven to work. And we do think that we're going to continue to see, more and more of this recognition really around the risk management standpoint, driving, these return numbers. And so this is the pictograph. I always like pictures. So this is kind of where your historical portfolio has been. So based on what markets have actually done, this is kind of where you would sit in your efficient frontier or your risk return chart. Now, going forward, the expectations for returns and volatilities of these public market assets has changed, right? Our forward expectation is not what we saw in the past. And so based on what we think we're going to see from public markets going forward, maintaining that same 60-40 portfolio is not going to serve you in the same way it has in the past. Expected increases in volatility and decreases in overall returns. So this is why I'm so busy these days, and this is why we're hearing a lot about it in the markets, is because it's required. Based on where we see the market moving, we need to do something different. We need to use more of the tools in our toolbox in order to improve our potential outcomes. And so, it's all well and good to say we need to do these things. Implementing a new idea or a new portfolio, framework can be very difficult. I understand many of you might work within a committee context. And also for many of us, even as individuals, it's an area where we may have less experience or exposure or knowledge. And so it can be difficult to think about where do we start. So I wanted to provide a framework that really outlines a 3-step process, and we can show how each of the pieces of the puzzle can fit together to create a broader implementation. So step 1, adding private credit. I think this is the easiest step for many people, and also the way to best mitigate some of the drag in your public fixed income portfolio as it currently stands. So getting that diversification back into your portfolio that maybe is not being delivered in your public fixed income assets at this point in time. Moving into private credit is a nice first step to improve your efficiency and also your income potential in your portfolio. So again, providing a consistent source of income, increasing your diversification, reducing volatility, and really providing more of a cushion to those interest rate movements. What the Fed's going to do, what the Bank of Canada is going to do, ECB. I mean, we all have our ideas. What you're thinking about in terms of portfolio construction is, how can I insulate my portfolio? So we always care what's happening in the market, but we'd like to be less impacted by the whipsaws that we see as a result. And so this is what private credit can really help you with in your portfolio. So predictable, consistent source of income. So this is sort of your efficient frontier, right, that we've all learned about. So your expected return per unit of risk. So your traditional 60-40 portfolio falls somewhere along this line. By adding 15% of private debt, so taking 15% out of your traditional fixed income portfolio and moving it into private debt, pushes your efficient frontier up into the left, which is what we want, right? So you're getting more expected return per unit of risk. So in the case of the addition of private debt, you're getting additional return and really not adjusting the risk in your portfolio all that much. So here are the numbers kind of behind it, just to break that down. So you can see the 15% addition to private debt here. Expected return is quite substantially improved by capturing that illiquidity premium that we get from private credit yields, that additional 250, 300 basis points that you can pick up in private markets. And you can see that the risk profile is staying pretty consistent. So as a result, your efficiency or your Sharpe ratio is improved substantially by the increased return without increasing your risk. So again, providing that consistent source of enhanced income over periods of time, that's really what you're trying to achieve by including private debt into your portfolio. Step 2, real assets. So this is really targeting inflation protection. So we want to have assets that are positively correlated to inflation. So in an inflationary environment, the returns that you achieve through these assets are highly correlated to inflation. So you benefit in terms of higher returns as inflation increases. So examples of this are real estate is one that is, we often think about rents go up when inflation increases, as some of us may know. So the return in your real estate portfolio will also increase, for example. Infrastructure strategies, right? So strategies that are not correlated to markets are really, the necessities of life. If you're commuting and you cover a toll road, you're going to continue to pay the toll even if it goes up 30 cents. I mean, it's a critical component. Same with energy, as we know, those energy assets are very highly correlated to inflation, and we see that every day. And so having that exposure in your portfolio can help to insulate your portfolio from those market movements as well. Another asset category that we see there is agriculture as well. Again, another kind of foundational input into life as we know it. So having that positive exposure to inflation in our asset portfolio can really help us as we see the cost of our liabilities also increase with inflation. So again, our efficient frontier, by adding these real assets to our portfolio, we're able to shift our portfolios up into the left. So we're getting some incremental expected return, but look at that reduction in risk. That is, hugely positive from a portfolio construction perspective, and also, really diversifying the types of exposures that we have in our portfolio. So our factor exposures, or the types of things that our portfolios are going to react to, is diversified and creates broader stability overall. So again, here are the numbers around it. So we've taken, 15% allocation to real assets here in the line here. And you can see expected return. We see a bit of a bump in expected return, but the real beauty, the real payoff of these assets is really in the risk component. So you see a dramatic drop in the portfolio risk by being positively correlated to inflation and diversified against, it's a negative diversification like we saw in an earlier slide, to kind of public market betas, and as well as to our private debt beta as well. So very highly positive from a Sharpe ratio perspective. Okay, so we've added private debt, we've added real assets. Let's get the return in there, right? And that's where private equity can really have that big payoff. We saw that 17 plus type return that we've seen from private equity over the past 5 years. It's been the best performing private asset class in terms of return. And really, there's a number of structural reasons why this actually should persist over time. So it's not just more people are involved in it, bidding up prices. Private equity owners really have the institutional knowledge and capability to improve businesses really at their core. So they're able to provide catalysts for growth. They're able to provide, experienced professional management where, these, family-owned businesses maybe hadn't had it before. We're able to, really use different businesses in their portfolio, can create connections, can create supply chain connections, can create customers for one another or their businesses. So there is a lot of connectivity or network effects that happen from having a business owned by private equity. And again, from a portfolio perspective, as an asset owner, again, that diversification benefit comes through by having, much broader swath of industries and businesses that you can participate in. So more and more businesses are staying private for longer. And so, you can get access to some really great, unique opportunities that just aren't public yet. And so broadly diversified, both in terms of asset class, but also in terms of the types of things that you're holding within your equity portfolio. So this really creates that growth initiative from your portfolio that allows for, a broader capital base on which you can then continue to grow wealth in your portfolio. So what does this do from our efficient frontier? Here we're really getting this boost in return, but also a substantial benefit from reduction in volatility as well. And looking again at the numbers, so we've taken 10% out of our global equity portfolio and put it into private equity. So here we've seen another 70 basis points increase in your expected return and about 70 basis points decrease in expected risk. Also see very strong income return. We see a slight dip from adding the real assets, right? Because we had to, pull some of our assets in for private equity. But overall, still compared to where we started, very strong overall income return as well. So high total return, low risk, high income. So what are some of the hurdles, right? All great ideas, but when it comes to implementation, it can be challenging. I'm not gonna pave over the fact that it can be a difficult conversation, and it's certainly a long process for many organizations as well that maybe have a variety of different stakeholders with their own, varying backgrounds as well. So I would say traditionally, one of the biggest hurdles was being an outlier, right? You don't want to be a first mover in institutional asset management. You don't want to be the one that kind of is stepping outside the norm, maybe creating some, differentiated returns versus a benchmark, for example. I would say now this has really evolved where it's almost flipped. We're not being involved in alternative assets or private markets is a little bit more unusual. So we have certainly seen over the last, I'd say 3 years, a big move into the market for a variety of reasons. And we can certainly talk about that as well at the end. Being uncomfortable with unknown or unfamiliar risks. One of the most common things that I hear from new investors in this space, or those that are just at the stages of contemplating private markets for the first time, is this view that private markets are somehow riskier, right? So, I'm not sure my committee is comfortable with the risk of investing in private markets. And, certainly the risks are different. There's different sources of risk. Certainly liquidity is one we talk about often, is a different risk from market. But I would also suggest that public markets, the liquidity in those markets actually creates a different type of risk, right? It's a mark-to-market risk. It's the risk that you have to rebalance at the wrong time. It's the risk that when you actually want to transact, you're not getting the price that you think you're going to get. So there's different sources of risk with different types of market exposures, but I wouldn't say one is necessarily more risky than the other. They're just different. And so certainly understanding where you're getting your risks, how you're managing your risks, and how those risks fit together from a portfolio standpoint is definitely a conversation that should be had, and certainly a hurdle that needs to be overcome, I think, in the way that many of us think about private markets. So we've kind of seen the math, and we know that actually putting private markets into your portfolio reduces risk, but it's not a simple yes or no kind of a discussion. So it is something that definitely needs to be explored. Kind of hand in hand with this is the investment complexity. It's not a market where we're familiar, many of us. There's a million different things that are calling themselves private markets, and they vary very widely between, what private debt is to one investor versus another investor can be very substantially different. And so, kind of wading through the complexity of the market is definitely a challenge. It's a challenge for everyone that's participating in it. And that's why, often having somebody who is more familiar with the market to help, like a consultant or, somebody in your organization that has some experience can be very, very helpful in moving that discourse forward, because it is very complicated. And investment managers can be a bit tricky as well, to be honest. Like, there is that level of complexity also creates, a little bit of opacity in what, different people are doing. And so really being able to peel back the layers does create a hurdle for new investors. Absolutely. So here's this one about illiquidity. So certainly illiquidity is one that I hear a lot about private markets. And that's actually, I think, one of the benefits of the market is the inability to transact at inopportune times. So by creating this kind of structural illiquidity from the types of instruments and the types of investments you're making, really does create more of a buy and hold mentality by necessity, which saves us from, making the wrong move. And I think that's why, a big reason why this illiquidity premium really persists over time. It's really saving us from bad investor behavior. So on the one hand, yes, you do need to understand that you're not going to be able to pull your assets next day from these structures, and some of them not for many years. But also there can be benefits to that. So again, it's really looking at it in a broader portfolio context. How much liquidity do you need? What's your investment horizon? And how can you diversify your liquidity needs as well across a broader portfolio? Also, I would say, the types of instruments available in private markets have definitely evolved as well over time. And that's one of the biggest shifts that I've seen in the last couple of years, is really this democratization of access, allowing smaller, mid-sized investors to be able to access private markets that in the past, $10 million minimums locked in for 15 years. That's not, necessarily the case anymore. So there are many instruments that will provide access on a more consistent basis to capital. I would say that all of them, no matter what they tell you, all of them are going to be best efforts, right? So it's nice to have the ability to put capital in, but you do need to understand that regardless of the structure, there's always going to be a caveat as to how you pull money out. So there's certainly more opportunity set, but again, you do need to kind of think about it in a portfolio context. How much, how often are you going to need access to your capital? When you want to, rebalance to, finance a new roof or something as exciting as that, you're probably going to have access to capital. But if, the whole markets are imploding, it's probably a good time really to stay invested anyways. And so that capital may not be available. Some private markets have embedded liquidity into them. So I spend a lot of my time in private debt. Those funds actually throw off a ton of cash. They have high coupons, often the loans amortize. And so actually your liquidity, your access to your capital is very, very strong in that type of structure. The loans also have a finite term. So at a certain point, you're going to get your money back because your loan is going to mature. So in those types of structures, there's actually a ton of embedded liquidity into the profile that, might actually be more challenged compared to, a public market. So again, a lot of nuance, a lot of education, a lot of discussion, and a lot of, I think, preconceived ideas that maybe don't actually necessarily hold if you kind of dig in a little bit more. And the last one here, sticker shock, this one's true. So private markets are more expensive. It takes a lot of labor to originate these loans, and we'll talk a little bit more about what makes a good manager or what you should look at when considering different managers. But they will be more expensive, absolutely. And so when you're thinking about it from an investment standpoint, I would encourage everyone to look at it from a net return perspective. So, because you are getting such higher expected returns in your portfolio, even if you're paying more from an absolute dollar basis, your net returns could still be substantially better than what you would be getting in potentially another access point. And then also within the broader portfolio context. So if you can preserve wealth, grow wealth, create better income, create a more stable portfolio over time, that pays dividends, both literally and figuratively, which, you might find extra value in as well. And so you should be expecting to pay more on an absolute dollar basis. But I think really evaluating the worth is an important, just change of reference in terms of when you're evaluating private markets. So summary. So was it all worth it, right? It's a lot of work. There's these big hurdles we have to, overcome. What was the end result? And I would say really across the board, both historically and, expectations going forward, I think what you can expect to achieve by creating this more diversified portfolio that includes private markets is an enhanced return profile, enhanced income portfolio, more downside protection, lower volatility, and at the end, a higher Sharpe ratio. This doesn't look like much, but it's actually more than 2 times better in terms of a Sharpe ratio. It's just a scale problem. So it is, I think it is worth the effort to consider, how you want to implement your portfolio in private markets. So finding the right partner. Obviously I come from Fiera Capital, which, I think is a fabulous, investment manager. We manage both public and private markets, across the globe, really. We are based here in Montreal, managing over $160 billion in assets. About 18 billion of that or so is in our private market business, and definitely where we've seen a lot of our growth and where we do consider, we really do add value in terms of our client experience as well. So being able to create these diversified portfolios, we think will well situate our clients going forward. So these are kind of some of the things that I think about. I've worked with a number of institutional managers and always picked what I think to be strong contenders in the institutional management space. And these are kind of some of the themes that I see permeate, what I think differentiates a good manager from one that might be less good. So first of all, experienced, dedicated teams. This is really, really critical in private markets. And this is very different than when you're thinking about a public market exposure. So one of the biggest difference in private markets versus public markets is sourcing, right? You'll hear private market investors talking about their sourcing networks. So when you're looking to buy, an equity or a fixed income investment, you pull up your banking, portal, you pull up your Bloomberg screen, tip, 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 if the price is right, hit the bid, you've got your asset. In private markets, none of that exists. You have to really go out and create your opportunity set. So having deep relationships in the specific market in which you operate, right? We talked about all these different asset classes, all these different ways that we can access private markets. You need to have a network in that asset class that you're targeting in order to create this differentiated opportunity set. So if you're seeing 60 investments and you need to deploy capital into 10, you can't be that picky, right? You really have to, kind of invest, in pretty much the best of what you see. If you're seeing 300 investments and only need to invest in 5, you can therefore be a lot more picky in terms of how you're deploying capital. So really being able to create this big network of good opportunities is really kind of a precondition to being successful in private markets. The second reason why I think this experience of teams is really important is because also different than public markets, private market contracts are individually negotiated. So it's not a boilerplate, it's very customized. And this is why people pay more, right? This is why people who are borrowing from a private lender, who are selling a portion of their business to a private equity owner, are willing to kind of pay up for that relationship, because they can be strategic, they can be can customize contracts, they can come up with nuanced ideas and be creative and adding and generating value to that business. And so having someone that has been operating in that space for several decades in many cases is also very important in terms of creating that learning, that feedback loop, what works, what doesn't, all those network effects. A rigorous and consistent investment process. This is very important, obviously, as well, really in any investment approach, really having a well-articulated plan on how you're going to invest capital, especially over, large teams, the amount of legwork required and to develop these opportunities. You don't want to have that kind of key person dependency. You want to have a team that has, multiple origination folks that are all following the same playbook, that all have the same level of rigor. You don't want any kind of lone rangers out there. You really want to have that process in place so it's codified and can be, demonstrably met over time. Independent risk oversight and valuation. So clearly risk is very important. Many of these assets are held over very long periods of time. You want to make sure that you're building a portfolio that's going to be consistent with the risk expectations of your investors. And then also valuation. So unlike public markets, right, valuation in private markets is a little opaque. And so from an investor perspective, you want to make sure that your manager has substantial oversight into how they're valuating those assets. Often you'll see private equity, for example, they generally tend to be really conservative and they'll sell an asset and they get a nice little pop, which is great as well. But this does become more important on these open-ended structures, these structures that will take capital in on like a monthly basis. Having a valuation that is really reflective of the actual value of the assets becomes more important when you're transacting, right? And so I think this is an area where we're going to continue to see, more and more scrutiny as the types of structures change as well. So ongoing oversight and management. While the, underlying assets are generally kind of a buy and hold type approach, you want to make sure that you're actually have a manager that's, providing good oversight, that's, in equity investments is actively engaging with managers, actually looking for opportunities for growth, and making sure that the management teams that they're investing in are also living up to their end of the bargain or delivering on what the expected performance targets were as well. And then certainly qualitative factors. In many cases, these are long-lived assets. These are long-lived funds. These are, long-lived relationships. Many spending, can be more than 10 years. You could be signing up to invest with a manager. And so just making sure that you're kind of philosophically aligned, like the team, like the people. I mean, it's very important to feel like you're getting access to information and kind of want to work together, right? That's very important when you're developing these relationships. ESG is also an area where we spend a ton of time as a firm. We think it's very important, from the way that we've grown our firm and from, the employees that work at Fiera. We put a lot of value on these considerations. And it is very different, actually, depending on what asset class, kind of what you can do in terms of actually creating action around these ESG considerations. I would say in general, from an underwriting or investment perspective, it's always been a part of our process. We want to invest with great teams that are building, good businesses that are going to stand the test of time, which essentially ticks the boxes for ESG. What's really changed is how we monitor it and how we report on it and how we impact our investments in terms of change. And so that really depends on the asset category in particular. So starting with private debt, it is a fixed income investment. You're not sitting on the board. You don't have equity ownership. And so once you're in a loan, you're a little bit more limited in terms of your negotiation power. And so the way we approach it is primarily from a negative screen. So if we see something that doesn't pass the sniff test, we just say no, we decline. And this is where having that big sourcing network is so important. So we don't need to kind of stretch in order to make something work that we don't think is, meeting our high ESG standards. We can just say no, thank you, and move on to the next opportunity. That being said, once we've put a loan out there, we absolutely monitor it, make sure that all of our criteria continue to be met over time. And more we're looking for opportunities to potentially include KPIs in terms of some of our covenants. So potentially, step downs if certain things are being met. So there's lots of ways that we're continuing to investigate and, action how we can, structure our loans differently. A lot of our portfolio also naturally tilts towards those businesses that are doing this stuff anyways, because it's a good long-term, business objective. We do a lot of investments in infrastructure debt, for example, where things like, alternate power sources, solar, wind, biomass, those are just areas where we see a lot of, interesting opportunities for great businesses that are going to thrive going forward. Also social, investments such as, multi-residential real estate, providing loans to those developers that are providing, affordable housing, things like that. There's a lot of opportunities to kind of find businesses that are well aligned. In real assets, again, it tends to be quite embedded. So real estate and infrastructure in particular really lend themselves to these types of initiatives. So in our real estate equity portfolios, for example, looking at energy efficiency in our buildings, creating, retrofitting our buildings in order to improve rents because the buildings are more attractive to tenants, for example. Investing in buildings that are considering the social network around them, creating parks and opportunities for green space and full thriving communities. So that kind of is naturally well aligned, but we can also impact it, once we're invested in a business as well, and really be a force of change in these businesses. And then finally, private equity. This is where we get our biggest stick, right? Where you're an owner in the business and you're really trying to develop that business for the next owner, for the next generation. You want to make sure that, ESG can be a great catalyst to improvement of the business for the long term. So there's a lot of really interesting ways that we can work with teams to improve a lot of the, diversity, for example, of boards can be very much impacted through our work with our equity investments as well. So there's certainly lots of different ways that we can engage. And I would say this is one of the benefits of private markets more broadly. You're a more active participant in shaping the way that these businesses grow, both in terms of management, in terms of their market, and in terms of their impact on the environment as well going forward. I won't stop on the disclosures. So with that, I think we have about 10 minutes left. I did want to pause and see if there was any questions.
Yeah, thank you very much for that, Sarah. Really, really appreciate it. I personally learned a lot there. Like I found kind of the applied sort of perspective and kind of the overview they provided was phenomenal. Actually, I learned a lot, and it's kind of a good balance between some of the basics and then getting into some of the more granular sort of details. So really appreciate that. So for the audience here today, feel free to use the Q&A function. So it's not necessarily the chat, but there's actually a separate Q&A function. You could punch in your question and I'll sort of ask it on your behalf. But just to kick things off, Sarah, I have a few questions here. And the first question is really around the opportunity set, right? So I think you mentioned earlier on that, especially in Canada, some DB plans have had their allocation to private, market strategies sort of rise from like 7% to 25%. So there's a lot more capital flowing into the space. Has the opportunity set sort of increased proportionately, or is this becoming, a somewhat saturated market?
Yeah, thanks for that. So one of the interesting dynamics we have definitely seen, and I spend a lot of my time in private credit, so maybe I'll use that as an example. So that's certainly an area where we've seen tremendous growth, looking at kind of, very high 5-year CAGR, like 20% growth over the last 5 years per annum. And so what that's meant is really, as more capital has come in and private equity has demanded more capital in order to finance their businesses, we have seen a lot of money sloshing around the system. Yeah. So that's kind of encouraged a lot of managers to grow their fund sizes. So one of the dynamics we've seen, for example, in private debt is a typical fund size 5 years ago maybe was, 600, 650 million. Now we're seeing funds in excess of $5 billion. Right. So, it's a lot of capital that these firms are raising. And so if you're populating a fund of $5 billion, you're going to be looking at deal sizes that are at least $150 million, if not $200 million, just to make your capital allocation efficient. So what that's done at the larger end of the market is really created some competitive pressure, for example. So what we've seen in credit is we've seen those yields sort of compress over time. And what managers have done in order to compensate is provide fund leverage. So by levering up their funds, they're able to continue to deliver, the same types of returns that they were delivering 5 years ago, but the actual loan yields have become lower. So what we've done a little bit differently to counteract this at Fiera is we really focus on the lower to mid-market portion of the market. So our maximum fund size in a closed-end fund is sort of around $1 billion. Our open-end funds maybe around, $2 billion because those loans are rolling, $2.5 billion. But by having a platform that can support these businesses, that can support these investors, they don't need to grow their funds so large. So we provide, Fiera can provide mid-back office support, accounting support, et cetera. And so they can really focus on the investments and populating these funds with smaller, $30 million, $50 million deals. And so there is definitely a bifurcation in the market a little bit that way.
Yeah.
And then I would also say that just the creativity has abounded in the space. So, there's been a proliferation of different types of investments getting more and more and more niche. So certainly, for investors who are inclined, there's a lot of, opportunities that you can research and you kind of build out diversified portfolios, or there's a lot of funds. We offer one at Fiera where you can kind of have a single point of access to a diversified set of different types of exposures as well. So there's certainly been some interesting dynamics resulting.
Okay, interesting. Yeah, the use of fund leverage and sort of creative, solution set as well, and also, I guess tackling a different subset of the broader market. So that's very helpful. We actually did have a question come in, so I'll sort of read that out. This is from Ahmed. So speaking on private markets, i.e. equities or private credit, how do you see the emerging markets could add in terms of returns and risk profiles of the portfolios, especially in light of the current economic environment? So, just to kind of paraphrase, in this sort of uncertain or, maybe one could even say turbulent, economic sort of outlook, how do you sort of, balance that?
Sure. So at Fiera, we don't do direct investments in the emerging markets. So I'll just put that out there as a caveat. And the reason is because rule of law and document enforcement is really, really critical in terms of private market investing. So if our skill set doesn't align with being confident that we can, enforce our contract in a certain environment, at this point, we see lots of opportunities in those markets, those OECD markets, where we feel very comfortable that those things are in place. So that's just not an area where we're actively investing at Fiera. Now, that being said, there's definitely opportunities for those that have the skill set to access it in a way that they are confident at the end of the day that those contracts are going to be implemented as well. I would say, emerging markets in general often do have a very heavy currency component to it as well. So I think if you're going to be investing in those markets, it's really a lot of interest rate currency exposure often will dominate your return profile. So again, it comes down to thinking about what are the factor exposures that you're trying to achieve and access, and how's the best way to do that. For us, we've seen lots of opportunities to invest in assets that are giving us those factor exposures we want. But certainly there's going to be managers out there that have skill sets to also, farm those markets effectively.
Yeah, there's definitely a whole new set of risk factors for sure. So one other question that we have, and this is sort of, I would say, a bit of a follow-up to the first question that I asked. So just essentially, in this market environment where once again it's uncertain, the outlook is sort of unstable, and at the same time, there's this rise in popularity in private market strategies. So it's becoming more competitive, like you said, yield compression earlier. So how does that impact sort of return expectations just going forward as as a whole for these asset classes?
Yeah, well, actually, so, I hate to, use private credit as a crutch, but it's actually one of the areas that's benefiting the most from this market environment, because rising interest rates are also increasing the yields that we're able to achieve in our loans. And then, a nuance really bringing in this market environment is when public markets are volatile, people are less inclined to access them, right? So if you need capital, whether it's equity or debt, if you don't know where your pricing is going to be, it's very hard to plan your capital expenditure. So private markets creates a source of certainty for the users of capital. So what we also find is that the value of private market solutions is also increased because we're able to deliver, certainty of execution, which public markets can't. So, for example, using private equity as an example, investment banks are very reluctant to finance any type of deals right now because the syndicate markets have been closed. And so the ability to get that off their books is less certain. And also the capital charges that they also are subject to because of market volatility is higher. So those two things combined have really pushed a lot of investment banks right out of the market. And so that creates a really good opportunity set for those investors that have kind of patient sources of capital sitting on the sidelines. So what we're seeing in terms of, especially being in the mid-market, that's a little bit less crowded to begin with. Many of our competitors might be focused more inwardly, kind of dealing with issues in their portfolio that may be coming to light. Our portfolios are sort of building into this environment. So we're lucky in that we're more outwardly focused and can take advantage of these situations. So I think there's going to be actually a lot of opportunity to have some very strong vintage years in this market environment for those that do have the capital kind of on the sidelines ready to go. And I would just say that in terms of volatility, I think it's very hard to predict, what's going to be in 5 years. And so this is really where the diversification argument comes in. So my expectation is that there's going to be a lot of opportunity in private markets. But overall, I want to make sure that I'm well diversified across my portfolio because it's less clear, where those opportunities are going to arise.
Yeah. So on the private credit side, there's higher yields. Obviously, there's benefits there. And then on the private equity side, we're seeing a lot of kind of multiple compression, valuations going down. So it's actually not a bad time right now to be, entering that space. So we've had another question here, and there's a shout out for your elaborate presentation. So thank you for that. So the question is, just with regards to the efficient frontier. So I know we saw it sort of going up and to the left as you add on, private credit, real assets, private equity. So the question is just over how many years was that sort of calculation done over? Like, is it sort of over 5 years, or was there like a 40-year horizon?
It's a good question. Yeah, so it's based on we have a multi-asset class group of actuaries actually here at Fiera that puts those together for me. So I believe it was over the last, I want to say 10 years of data, but I would have to confirm that, to be honest. So I can circle back to get the exact numbers, but it's based on sort of where we see the public markets versus our experience in our private portfolio.
Yeah. Okay. Good. Thank you. There's another question that came in. So thank you everyone for all the questions. I think this might be our last one, or possibly one more after. So this one's from Chris. As private markets become more investable to retail investors, do you foresee liquidity to decrease from quarterly to monthly? So I'm not sure what that means. Maybe it's quarterly to monthly reporting. Also, could you quickly touch on the industry average in terms of management fees? So it's sort of a two-part question. It's, do you foresee liquidity decreasing? And maybe I might actually tack on my own little question there, which is maybe just provide just some quick commentary on liquid alternatives. Yep. The second piece is just on management fees.
Yeah, so in terms of liquidity, I think this is also an area where there's a lot of differences between different managers. So this is where I think reading the fine print becomes very important. So, we have a variety of open-ended structures at Fiera that have different liquidity terms. And I think the most important thing to think about when evaluating liquidity is, does it match with the assets? Number one, right? So what is your manager holding? Is a reasonable expectation that the assets that are supporting it will naturally roll. You shouldn't expect that your manager can sell or, distribute assets to a second party if they're actually private market assets. So when we're structuring our liquidity, we look at the natural term and the natural role of the underlying assets to determine what is the natural liquidity that we can provide to investors. So that I would say is number one. Number two, if your investor or your manager has a frequent liquidity profile, like for example, monthly, just understanding what the assets are. Many managers will hold public market assets in order to meet that liquidity provision. Managers will also have, access to credit lines, which is fine as well to meet that liquidity provision. So just understanding how they're meeting the liquidity. Does it match with the liquidity that they're providing? And what are the potential impacts on your overall risk return in your portfolio? So obviously holding, public market securities is going to diminish some of the private market benefits, right? Which is fine if liquidity is important to you. The other thing I would caution about liquidity, I think liquidity going in can be very, very helpful. So like a monthly liquidity going in, I think is quite common these days. The back end is where, the liquidity provisions can vary from monthly, quarterly, semi-annually, 3-year lockup, 2-year lockup, right? So just understanding that much. But I would caution, and I have this conversation a lot with our private wealth group as well, is you need to make sure that you're not starting to think about it like a public market substitute. So if you need that liquidity, if you expect to have access to it on an ongoing basis, the question is why, right? It shouldn't be seen as a tradable asset, because in all these benefits that we talked about, this incremental yield, this lack of volatility, this lack of mark to market starts to diminish if you're trading, right? It becomes another tradable asset. So I would think, I do agree that as we look upon the competitive landscape, liquidity provision is an area where managers are trying to compete, more and more promising monthly liquidity. But if you read through it, there's often, 5% of NAV, best efforts basis, so, and we're seeing it actually in real estate portfolios now that have been structured for more retail. We have seen more and more gates that investors maybe weren't anticipating. So to answer your question, yes, I think we are going to see liquidity provisions shorten. But I would also encourage investors to think about, would they want to access that liquidity? Why? And push comes to shove, can they? So just read the fine print. And then I forgot what the second part was. Oh,
yeah.
So
yeah, just average or typical fees.
Yeah, so it's hugely different. It depends as well. Institutional investors will often get volume discounts, right? If you're investing $100 million in a closed-end fund, your fee is going to be different than a liquid, portfolio that's being actively portfolio managed, for example. So I would say, typical underlying fees that we often see, private equity, the 2 and 20 model is alive and well. That's not atypical, kind of as a headline fee. In, real assets, there's a big range, but something like a 1 in 10, 1 in quarter, like 1% management fee, 1 1/4, performance fee on an institutional portfolio would be, I would say, in the realm of typical. And then private credit actually varies widely, because you'll have private credit that includes a lot of equity type exposures as well, more like a buy to own type portfolio. And then you'll have very tried and true state, credit. So we, even in our own shop, we have a big range of fees from, flat management fees, less than a percentage, to more of like a 1 in 10 type model, 1 in 1 1/4 is sort of in line with sort of the real asset portfolios, just very broadly speaking.
Yeah, that's helpful. That's helpful. Well, Sarah, we're past 1 p.m. here, so I think we'll need to wrap up. But I just want to thank you very much on behalf of the CFA Society Ottawa. I really enjoyed this presentation. I learned a lot. I work in the private equity space, and I still learned a few things. So I think there's a lot of value here for everyone that's joined on the line. So once again, thank you very much. For everyone else on the line, I just wanted to, continue to sorry, to encourage you to continue to monitor our events page on the CFA Society Ottawa website, our LinkedIn page, right? I mean, we're going to continue to have more and more of these events. And our next event will actually be on December 7th, which will be with Franklin Templeton. And that one will cover US recession risk. So that's going to be kind of a dinner at the Rideau Club. Actually, our first sort of educational event at the Rideau Club, kind of in the sort of post-COVID environment. So highly encourage everyone to check that out. Sarah, once again, thank you very much. And everybody else, have a good rest of your day and see you soon.
My pleasure. Thank you.